If you were born before 1961, the moment you reached age 65, you became legally entitled to skip an entire collection of bills and taxes that you are almost certainly still writing checks for. And not a single person whose paycheck depends on collecting that money is ever going to pick up the phone and tell you to stop sending it. I want to make absolutely sure you understand what I just said, because it is the single costliest misunderstanding I encounter year after year without fail. Turning 65 did not simply make you eligible for Medicare coverage. It silently moved you into an entirely different category of people that the federal government, your state, your county, and several additional agencies are legally obligated to treat in a fundamentally different way. There are bills that younger Americans are required to pay that you are no longer responsible for. There are taxes that shrink, lock in place, or vanish entirely the moment you cross that threshold. But here is the catch that drains thousands of dollars from people every single year. Being legally exempt and actually not paying are two completely separate realities. The law does not issue you a refund automatically. Nobody at the county office mails you a check. The agency that has been pulling money from your account for 4 decades does not send a birthday card saying, "Congratulations, you can stop now." You have to know the exemption is there and you have to submit the form yourself. That single gap between qualifying and actually claiming is the precise reason that most people who are fully entitled to these benefits never collect a single dollar of them. And before you conclude that this video has nothing to do with your situation, let me address the biggest myth circulating out there, because this is exactly how people end up talking themselves right out of money that is sitting there waiting with their name already on it. A lot of people assume a list like this one only applies to low-income retirees who are genuinely struggling to get by. So if you own a comfortable, fully paid-off home, you mentally check out and assume none of this is relevant to you. Then other people assume the complete opposite. They believe this only benefits wealthy individuals with large estates and expensive financial advisors on retainer. So if they are mostly living on a social security payment, they check out too. Both groups of people are incorrect, and both of them are leaving real money sitting uncollected on the table. Some of the items on this list deliver the greatest benefit to the lower income retiree. Others are worth the most to the person sitting on a home that doubled or tripled in value over the past several years. For every single item I cover, I'm going to tell you precisely who it helps the most, so that nobody watching can honestly say that particular one is not for me. And if you are currently renting, do not navigate away just yet, because one of the things on this list quietly governs how rapidly your landlord is legally permitted to raise your rent. So let me tell you who I am and why I am the one bringing you this information. My name is David Carter. I am a licensed estate attorney. For more than 15 years, I have sat directly across the table from county assessors, probate clerks, and government agency representatives on behalf of ordinary families. And I will tell you the most painful pattern I have witnessed across all of those years. It is not the individuals who attempt to manipulate or exploit the system. Those people are genuinely rare. The painful cases are the honest people in their 60s, 70s, and 80s who have done absolutely everything correctly their entire lives and who are still paying bills they were legally exempt from years ago, simply because not one single person ever sat them down and showed them which form to fill out. That is the most expensive kind of mistake in existence, because it is completely invisible. There is no past due notice. There is no financial penalty. There is no alarm that sounds. There is simply money quietly leaving your account every month, every year, that never had to leave in the first place. So let us fix that starting right now. Today I'm going to walk you through 5 of these exemptions one at a time in plain, straightforward language, with the exact thing you need to ask for on each one. Then I'm going to share a few bonus strategies at the end, specifically for homeowners who have accumulated some real assets, because those final ones can be worth a small fortune, and almost nobody ever discusses them publicly. I want you to stay with me all the way through to the end, because the 5th item on this list carries the highest overall value of everything I cover today. And it also happens to be among the very easiest to claim. If you only take action on a single thing from this entire video, that 5th one is most likely going to be it. Let us begin with the newest item on the list, because it is so recently introduced that almost nobody has caught up to it yet. And that is precisely why so many people are missing it entirely. Beginning with the 2025 tax year, every American who is 65 years of age or older qualifies for a brand new additional deduction of $6,000. I want to be completely precise here because people frequently get this wrong. This is not a replacement for your standard deduction. It is added directly on top of it. It is an extra $6,000 removed from your taxable income simply because you are 65 or older. And if you are married and both you and your spouse have reached 65, that is $6,000 each, totaling $12,000 as a couple, stacked directly on top of everything else you already receive. This is entirely new. It runs through the 2028 tax year. And here is the part that consistently surprises people. You receive this deduction regardless of whether you take the standard deduction or choose to itemize. It makes no difference which filing method you use. Now, it does begin phasing out at higher income levels. For a single filer, it starts decreasing once your income exceeds $75,000, and for a married couple, once it surpasses $150,000. At the very top end, above those upper cutoff points, it disappears completely. But consider who that leaves untouched. The vast middle ground, the retiree living on a normal, modest income. For that person, this represents real money removed directly from the amount the government is authorized to tax. Here is what genuinely troubles me about this particular item. The people it helps the most are the exact people least likely to notice it. The filer who is 65 or older, living on a typical income, who either prepares their own straightforward return or hands it off to a basic preparer who is working quickly through a large stack of them. That is precisely the person who will not stop to verify whether this new deduction was actually applied, and who will quietly overpay without ever becoming aware of it. So the action required here is simple and can be completed in 2 minutes. When your return is finished and before you sign it, review it and confirm that the additional senior deduction was genuinely taken. If you use tax preparation software, verify that your date of birth is entered correctly, because that is the trigger that activates it. This is not a confrontation with anyone. It is a single line on a form, and you simply need to make sure it is there. Number 2 is your property tax bill, and this is where the largest dollar amounts on the entire list are concealed. Pay close attention here because there are actually 3 separate forms that can be layered on top of each other, and the majority of people do not have a single one of them properly filed. The first is the Homestead exemption. What it accomplishes is removing a portion of your home's assessed value from consideration before the county ever calculates what you owe. In Florida, that portion is $50,000. In Texas, it is $100,000 off the school tax portion of your bill. Every state structures it differently, but in nearly every state, it represents genuine, meaningful money. And here is where people consistently get caught off guard. Most homeowners assume the homestead exemption happens automatically, that it simply activates when you purchase the home. In the majority of states, it is not automatic at all. You are required to submit a 1-page form to the county a single time, usually before a spring filing deadline. File it once, and in many states it remains active for as long as you own the property. Miss the filing and you pay the full unreduced bill that year for absolutely no reason. The second form layers directly on top of that first one. It is the senior or age 65 exemption. Most states that provide a homestead exemption also offer an additional one that activates in the year you turn 65. And this is the one the county will almost never proactively mail to you on its own. It requires a completely separate application, and you must specifically request it by name. In Texas, every homeowner who is 65 or older receives an additional $10,000 off the school tax portion on top of the homestead exemption. In Florida, the senior exemption can represent another $50,000 on top of the basic $50,000, effectively doubling the reduction. And here is the point where comfortable retirees incorrectly tune out. They hear the word senior and immediately assume there is an income threshold they will not meet. But in more than half the states that offer this benefit, there is no income requirement whatsoever. Texas, Florida, Georgia, Tennessee, Alabama, and others. You turn 65, you file the form, you receive the benefit. Age is the only qualification that matters. The third form is the most valuable of all 3, and it is called the Senior Assessment Freeze. Here is precisely what it does. When you turn 65 and submit the freeze application, the county locks your home's taxable assessed value at whatever it happens to be in the year you apply. From that point forward, it makes no difference how dramatically your neighbourhood appreciates in value. It makes no difference how high property values climb on your street. Your tax is calculated based on that frozen number indefinitely. In Texas, once you file the over 65 tax ceiling, your school district tax is permanently frozen at the actual dollar amount you paid in that year. Your home's market value can double. Your tax bill cannot increase. So who does all of this benefit the most? Honestly, nearly everyone in different ways. The basic homestead exemption helps the lower income homeowner the most in terms of raw percentage relief, but the assessment freeze is worth a small fortune to the person sitting on a fully paid off home that tripled in value over recent years, because they are the ones facing the steepest potential increases. And for renters, I told you this one would apply to you as well. Here is the reason. Your landlord pays that property tax bill and passes every dollar of any increase directly into your monthly rent payment. When those bills are frozen or reduced across an entire community, rents stop escalating the way they otherwise would. Number 3 is your Medicare Part B premium. This is the one that gets quietly deducted from your Social Security payment every single month before the money ever arrives in your bank account. So a significant number of people forget they are even paying it at all. In 2026, that premium runs approximately $185 per month, removed automatically every month without any visible transaction. But here is what almost nobody is ever informed about. There is a collection of programs called Medicare savings programs. And if your income falls below the qualifying threshold, your state will pay that Part B premium entirely on your behalf, not reduce it. Pay it completely. There are 3 tiers, and they are identified by the abbreviations QMB, SLMB, and QI. The most comprehensive tier, QMB, does not simply cover your premium. It also eliminates most of your deductibles and your co-payments on top of that. Here is what genuinely frustrates me about this particular benefit, and it is why I am dedicating extra time to it. The income limits are considerably higher than most people assume. Many individuals glance at the program name and conclude they earn too much to qualify when they would actually be fully eligible. Beyond that, a growing number of states no longer count your assets in the eligibility calculation at all, so your savings account balance or your paid-off home does not disqualify you from receiving the benefit. And despite all of that working in people's favour, this remains one of the most severely underclaimed benefits in the entire system. Millions of people who qualify right now have never submitted an application, purely because nobody ever informed them the program existed in the first place. Who does it help the most? Anyone living primarily on Social Security income. For that person, this benefit is enormous. The action required is a single phone call. Contact your state health insurance assistance program, your local SHIP office. The service is completely free, and they will evaluate your eligibility for a Medicare savings program and assist you through the application process. That one phone call has the potential to return close to $200 per month back into your Social Security payment. Do that math yourself and consider what it means over a full year. And while you have them on the phone, ask about one additional program in the same family, because it almost always travels alongside the first one. It is called Extra Help, and some people recognize it by its alternate name, the Low Income Subsidy. This program targets a completely different expense. The cost of your prescription medications under Medicare Part D, if you qualify, and a very large number of the same individuals who qualify for a Medicare savings program also qualify for this one, it can dramatically reduce what you pay for your medications, for your drug plan premium, and for your annual deductible. And here is the reason I bring it up immediately after covering the previous program. In many cases, receiving approval for a Medicare savings program automatically enrolls you in Extra Help at the same time. That means 2 of the single most significant healthcare cost reductions in the entire system, both unlocked through one phone call and one application process. For someone who fills multiple prescriptions every month, this is not minor pocket change. It can represent one of the largest financial benefits on this entire list, and it comes bundled directly with the call I just instructed you to make. Number 4 is smaller in terms of dollar amounts, but it is still a bill you are legally entitled to stop carrying in full, so I'm not going to pass over it. There is a federal program called Lifeline that reduces your monthly phone or internet bill by approximately $9.25. Many states layer their own additional discount directly on top of that federal reduction, which can push the total savings higher. And separately, if heating or cooling your home ever places a strain on your monthly budget, there is a program identified by the letters LIHEAP, the Low Income Home Energy Assistance Program, which helps cover that utility expense directly. I will be straightforward with you. This is not the most glamorous item on the list. $9 per month is not going to transform your financial situation. But here is the framework I want you to use when thinking about it. It is one more recurring bill that the system has already determined people in your circumstances should not have to carry entirely on their own, and it sits there unclaimed for precisely the same reason as every other item on this list. You only receive it when you ask for it. When you begin stacking several of these together, the smaller ones alongside the larger ones, that is when the combined monthly figure genuinely starts to shift in a meaningful way. And that leads me to number 5, the one I encouraged you to stay through to the very end to hear, because this is the item that silently costs people the most money year after year. And it is simultaneously the single easiest one on this entire list to correct. Remember that brand new $6,000 bonus deduction I described at the beginning? Well, layered on top of that, the tax code provides every filer who is 65 or older with an additional standard deduction. This is a second, entirely separate increase, and it has existed within the law for a number of years already. It stacks directly on top of the regular standard deduction that every taxpayer receives, and now it also combines with the newly introduced bonus deduction. When you add it all together, the regular standard deduction, the long-standing senior edition, and the new bonus amount, the result is that a very large proportion of people over 65 actually owe considerably less in federal income tax than they currently believe they do, and a meaningful percentage of them owe nothing whatsoever. But here is the quiet trap that catches people. Those same individuals continue over-withholding from their pension or their social security payment purely out of long-standing habit, or they continue handing their taxes to a preparer who never pauses to adjust their calculations based on the client's age, and so they hand the federal government an interest-free loan every single year and simply accept it as normal. In my professional assessment, this is the most widespread and the most correctable financial mistake that people over 65 consistently make. What most people do not fully appreciate is that the tax code is not concealing this from you out of any deliberate intention. It is simply that no component of the system is designed to walk over to your door and explain it to you directly. The most straightforward action you can take is this. When your return is being prepared this year, confirm that both your regular standard deduction and your age 65 additional deduction were actually applied. Then ask whether your withholding amount should be adjusted going forward so that you stop overpaying every single month. It is not a confrontation with anyone. It is a box that simply needs to be checked accurately. Now, if you do hold some meaningful assets, let me share a few bonus strategies that almost nobody ever hears discussed because, for the right individual, these can be worth more than everything else on this list put together. The first is a property tax deferral arrangement. In a number of states, once you reach a qualifying age, you have the option to stop paying your property tax bill entirely, with the state settling the accumulated balance later when the home is eventually sold or transferred to your heirs. You preserve your monthly cash flow now. The second is the surviving spouse carryover provision. When one spouse passes away, the senior exemptions and the assessment freeze do not automatically transfer in many jurisdictions, and families inadvertently lose them during an already devastating time. But if the correct paperwork is filed promptly, the surviving spouse can often preserve the deceased spouse's exemption rather than watching the tax bill spike during the worst possible year. And the third is one that people tend to dismiss until they actually calculate the cumulative total. In a number of states, once you reach a certain age threshold, your vehicle registration fees or annual excise taxes are reduced substantially or waived entirely. It is modest in any given year, but it is your money, and it is available to claim. So let me bring everything back to where we started by grounding it in a real person's experience. I once worked with a woman I will refer to as Margaret. She was 72 years old, living near Toledo, a widow residing in a fully paid-off home that had quietly doubled in market value over the years, getting by primarily on her social security check and a modest pension. When we sat down together and examined her complete situation, here is exactly what we discovered. She was paying the full Medicare Part B premium every month without any reduction. She was paying the full unfrozen property tax bill on a home that had appreciated substantially for years without any ceiling applied. And she was paying more in federal income tax than she actually legally owed because her tax preparer had never applied her senior deductions or made any adjustment to her withholding. All three of those situations existed simultaneously, and every single one of them represented something she had the complete legal right to stop. So we filed 3 forms together: a Medicare Savings Program application, the senior exemption and assessment freeze with her county assessor, and a corrected tax return. Nothing about Margaret's daily life changed in any visible way. She did not relocate, she did not sell any assets. The only thing that changed was how much of her own money remained in her account at the end of every month going forward. And here is the part I want you to genuinely absorb. She was not manipulating the system. She was not getting away with anything improper. She was simply finally claiming what she had already earned across an entire lifetime of doing everything correctly. That is the complete and entire point of what I am sharing with you today. Being legally exempt and actually retaining the money are 2 completely different realities. And the only connection between them is the form. The agencies collecting that money are not going to construct that bridge on your behalf. So here is exactly what I want you to do this week, and none of it will cost you a single dollar. First, contact your county assessor's office and ask them directly by name whether the Homestead exemption, the senior exemption, and the assessment freeze are currently on file for your property. If any of them are missing, ask which specific form adds them and what the applicable deadline is. Next, call your local SHIP office and ask them to screen your eligibility for a Medicare Savings Program. And finally, the next time your tax return is being prepared, verify that your senior deductions were properly applied and ask whether your withholding level should be adjusted going forward. And if the expense of paying a preparer is part of the reason you have been postponing all of this, listen carefully because you do not need to pay anyone. There are 2 completely free programs staffed by trained IRS certified volunteers. One is called Tax Counselling for the Elderly, and the other is the AARP Tax Aid Program. They will sit down with you and prepare your return at absolutely no charge, and they are specifically trained to identify every senior deduction that applies to your situation. So for the vast majority of people watching, the total cost of finally capturing every one of these benefits is nothing at all. That is the complete picture. A handful of phone calls and a few forms standing between you and money that has belonged to you all along. If this video caught you off guard, there is another one where I walk through those property tax forms in considerably more detail, broken down state by state. It is the same category of money sitting in the same kind of silence, and the link to it is visible on your screen right now. One final important note before you go, and it genuinely matters. Everything I have shared today is general educational information and does not constitute personal legal or tax advice. These rules vary meaningfully by state and by individual income level. Always verify your specific circumstances with your county office, your state SHIP office, or a qualified professional before taking any action. And if anything in this video was genuinely useful to you, do one thing for me in return. Forward it to one person you know who is over 65. It will cost you nothing, and it just might put several $100s back into their pocket every single month. I will see you in the next one.